Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, Lance Peterson. Thank you for joining us. So today I have with me Randy Langenderfer. He is based in Houston, Texas, and his firm is InvestArk. How are you doing today, Randy?
I'm doing real good, Lance. Thanks for having me.
Yeah, no, my pleasure. So mutual acquaintance of ours, Brian Briscoe, strongly recommend that I have Randy on the show. He's a wealth of knowledge, and looking forward to our conversation today. So before we jump into the meaty stuff, Randy, why don't you share a little bit with us about how you got into real estate investing? I know that you have a career and have had a career in another area. And so I think you're a perfect fit for sort of this audience who many people might be in the same position you've been in the past and are looking to, maybe get to a place where you are. So maybe share a little bit with us how you got into real estate.
Well, Lance, first, thanks so much for having me on your show. I really appreciate it, and I look forward to it. It's my journey started, this is 2021 as we're recording. I was in late 2008-9, stock market crash. I saw half of my net worth vanish in a period of about 3 months there with the stock market decline. And I was aging in the corporate world, and I was working for a private equity company that churns and burns. And I really decided I needed to find another stream of income. I didn't really want to step away from the corporate world, and I had a brother-in-law whom I really respect, really highly educated, came to me and wanted me to become a hard money lender for single-family flips. At the time, I was living in Cleveland, Ohio, and he had connected with a group out of South Florida, and so we did 12, 15 different flips in South Florida. This is in the highlight of the 9, 10, 11 era when, single-family properties were available and prime for this model. But I relocated to Houston, Texas in 13 and for corporate responsibilities. And so, yes, I still have a W-2 job, and I don't want to quit it. I want to keep it. And I think I can do both with nights and weekends and multifamily. And my day job requires a lot more, perhaps, hours, but I don't mind it. But got involved in multifamily in about 2014. I attended a Lifestyles, a big multifamily educational arm here in Houston. I was in that for a short period of time. I connected with the Sumrock Group out of Dallas, Texas. I was in that for a couple of years. And most recently, I'm in Rod Khleif's organization as a coach and for his students. And so I just really enjoy giving back, speaking to the new investor, the one that's thinking about passive investing and how they balance work life and doing this and doing that. I guess I'm living proof you can do it both, and you don't have to be that smart. So, yeah, because I'm certainly not.
Yeah, no, I mean, that's the beauty of it, right? It's like like anything in life. You're going to have to put in some elbow grease and hit the books. But I mean, I think that, comparing it to, becoming a hedge fund manager or day trading or private equity, leveraged buyouts. And there's certainly a lot of other sort of facets of the finance world and investment world that are far more complicated, right? And things that, seem, with the complexity, of course, comes, built-in risk, because if you don't know what you're doing, you can, really lose your shorts. And I think, look no further than Robinhood. And, hey, while I appreciate they're sort of making it easier for people to, kind of get involved and take control of their own investments, certainly the fact that it feels more like a casino and, and like it's some video game that you're playing or whatever you want to say is sort of terrifying, especially when you can, buy stock on margin and things like that. So, given the alternatives, I feel like multifamily is a great example. So we've all probably lived in an apartment at one point in our life, or, it's something that you can get your mind wrapped around, and ultimately, the best, one of the best, greatest value investors ever, Warren Buffett sort of, says, invest in things you understand. Right. So, I think it's definitely achievable.
And for me it was realizing real estate is where I wanted to start. I just didn't know how.
Yeah.
I'm proficient with a hammer, but I really no longer want to pound nails and replace roofs and sweat pipe together. So it became. I started out in single family, as I said, but it became just very time consuming with each new property, having to compare the comps, having to compare the rehab budget, and to get velocity, it was going to have to quickly have a whole lot of people working for me that I just didn't want to do at the time. And so, as you know, the multifamily lands, fast forward, I mean, there's upfront work to decide what you're either going to buy as a general partner or what you're going to buy into as a limited partner.
Yeah.
But then you sit there and do nothing for several years and watch your money grow and get distributions, and 5, 6, maybe 7 years down the road, it's sold, and
Yep.
thank you very much.
Yeah, exactly. Yeah, and it's all the while it's backed by real assets that you could go and see and touch.
Right.
And,
I know where each of my sponsors live as an LP. I literally know where they live and how to get a hold of them.
Yeah.
I don't know how to get a hold of any of my mutual fund money managers that I have.
yeah, I don't. Yeah, who knows?
I don't think if I called, they'd
Who
even
knows if
think.
they're real people? They might just be like bots or something. You never know.
It's good.
So it's curious. You've sort of studied under 3 of the larger educators in the space. I'm curious as to what are the consistent things you've seen. I mean, obviously, some of these things you learn for the first time, 8, 9, 10 years ago or whatever. But are there certain things that you, especially now in your capacity as a coach, that you just feel sort of like 101, or maybe it's something that people often overlook that you have to kind of remind them, like, hey, this is important. Don't overlook it because it sounds or seems simple. I'm just curious, since you have sort of,
there's a couple pieces.
Like
The answer to that one is I would say I think each of them has their own advantages. It just depends on what you as a buyer of that educational services want. I just have recently connected more with Rod's group and people in it than the other two, even though they may be closer in nature. I would say that the Lifestyles group tends to be very Houston-centric, though it's branching out and it's gotten much more nationally now. But same thing with Sumrock. He's very Dallas-centric, his core. I think Khalif has started more nationally, and he's got people all around the country. But I think the fundamental thing in that is, why would anybody join an educational group? And I think I encourage all the people I talk to do something, because, we all probably, if you're a college graduate, even if you went to trade school or something like that, you invested a lot of money in yourself for your 4-year degree or your vocational school or wherever you've attended. And I started out, so I'm a finance guy. I'm a CPA, MBA at heart, and so I'm risk adverse. And I was adamant I wasn't going to pay the big entry fee to some of these educational groups. Well, the reality is, I came to the conclusion I've invested a lot of money in my education, my undergraduate degree and stuff. Why should I be so afraid to invest some money in my real life education of real estate and do it the right way and learn from those who've gone before you? So I have done that. There's various degrees you can get in each and every one of those programs, but I think it's paramount for people, even if they're going to be a limited partner, to understand the principles and the underwriting assumptions that need to be understood. And that's the best way. As a limited partner, you're going to see general partners. You're going to hear about offerings and opportunities. When I first started, I looked for opportunities. I probably get 2 a week, it seems like, or at least 3 a month. And opportunities to invest in because of the way the market's at right now. So education is huge for, I think, every investor. Even, I'm sure you still have your own network of educational meetups or masterminds that you attend as yourself.
Oh yeah, no, I mean, I agree. I mean, I'm a lifelong learner guy. Like, I love learning, and and so it's definitely. I mean, there's always things that you can learn and that you don't know, and I think that's what we preach, or generally on this show, is that you have to take control of it yourself, right? Like to abdicate your own your financial freedom to others right? It's just that has risk in it. I mean, you need to understand that they don't care as much about your money as you care about your money,
Right.
and that's just how it goes. And I think that, but I can see how we got here, right? Is that the notion of, a generation or two ago, it's, you had a pension and you got a job and you stayed there forever and you retired and, they kept paying you. Right. So, and then it sort of, flipped on us to the 401k and IRAs and those sorts of things. And I don't think people sort of realized what was happening then. Right. So then they abdicated that sort of wealth management, so to speak, to other people like investment advisors and, people like that. And they didn't take it upon themselves. And so what I think I'm seeing here in the last 5-6 years is that I think people have now realized, because when you think of the 401k and IRA thing, that was late 70s when that stuff
Right.
took hold. So now you've seen a whole generation that goes, oh crap, I think we're going to come up a little short here. I don't think we have enough juice to get us to the end. Not to mention the gains in medicine and all advancements in medicine and those things. I mean, it's like, they can keep you alive for a long time. Good or bad or indifferent. That's just how it goes. And so, you're going to have money. So I just think what we're seeing is that people are realizing, oh man, I need to learn this stuff, right? And I need to figure out how to take control of it, because they're realizing that their account balances, really aren't growing fast enough, or they might be going backwards on them. And when you look at it, is that, well, who's running it, right? And it's some other party. And so I think that's really at the heart of it, is that people are realizing that, man, and you're seeing it now too with the millennials and, with Robin Hoods. And I mean, everyone's realizing like, man, we better learn how all this stuff works to take control of it.
And having lived through, I said, the 08-09 crash, that was just a real eye-opener when you saw literally half of my net worth dissipate over a period of about 3 or 4 months. And that's when I decided I wanted to become much more active. And you're right, there's so much educational opportunities out there today. Your podcast, others online, books, tapes, meetups that you can go to that don't cost you. I recently read that something to what you just said, the millennials are shirking the financial planners. Even when they have assets, they'd rather train themselves via YouTubes and venues like this, which makes a whole lot more sense, because you custom your investment options to you versus what some financial advisor's selling and getting compensated for. Kind of just that simple. You're developing your own strategy.
Yeah, you are, and I think that's the beauty of multifamily syndications. If we get really, really specific, is that I feel like it's the to the degree that you've accumulated enough wealth, right? In this case, to become an accredited investor, and obviously there's limited opportunities for non-accredited investors to get involved in some of these deals, but either way, it's a great on ramp into this,
right.
Into this world, and I think that. You said it sort of has mechanics that your everyman can sort of get their mind wrapped around when it comes to making an investment, right? Like,
and if
can they really bump rents $250, like in that part of town or whatever? It's like you can actually probably figure that out.
Process that. Yeah. Well, and that's the other thing, for your audience is how do the majority of the wealthy get wealthy? A lot. I always say I only know one. I'm sure there's more, but I only know of Warren Buffett, who made it through investing, through stocks and bonds. I'm sure there's more, but I can quote probably 10 or 15 I know off the top of my head that made their wealth through real estate. And the vast majority of those are through private placement memorandums, which are private placement offerings, of which multifamily is. They're not in some publicly traded REIT or something like that. They're in a private placement offering.
Yeah, and I think that's when you drive around through a city or whatever, is that and this is what we're going to see more and more of. I think this is a lot of real estate was I think a lot more closely held real estate by families, by individuals, those sorts of things. But what you're seeing is that most of the buildings, I believe, in the future that you drive by that are of the sub-institutional or non-institutional real estate is probably going to be syndicated, meaning that there will be a bunch of people who own a fraction of those buildings, through a private placement and in a syndication, right? And I think that's the sort of thing where, there's only so much dirt, there's only so much real estate, right? And we're also seeing this shift from, an ownership kind of culture to a rent culture. Like we like to just, look everywhere. People are just renting things out, right? Like they don't own things.
Self-storage,
they used to.
homes.
Everything. It's like you don't need a car. You just, call an Uber. You don't need a second vacation home because you have Airbnb. And we just see more and more of that. And it's because of the world is flattened and the mobility and the ability for people to go where they want to go when they want to go there. But that doesn't mean that ownership won't exist. And I think this is the good thing, is that assets are meant to be, assets should make you money, right? And I think that's before people would be, hey, if you're going to own a car, then just rent it out on Turo. That's not, now you've actually turned it into a real asset. It's an asset that could make you money. You can rent it out when you're not using it to other people.
And I think you hit on a big one there, and especially in the home, and that's soon to be that car. I was just listening to a news broadcast this morning that was talking about, personal real estate. I'll say single families, and all commercial classes are following suit. But single families, there's such a, asking price is starting price. So things are getting so much more expensive that it just continues to eliminate other people from buying a house. And so they're renting more. Like you said, they're renting an apartment, they're renting a car, they're renting self-storage units. It becomes a monthly operating income versus a large capital outlay that they don't have they may have a good income, but they don't have that balance sheet or that large outlay to make the upfront purchase, and they can get there, and it makes a whole lot more sense. I'm convinced in my lifetime yet, I probably won't own automobiles. Like you said, I'll probably be Ubering everywhere.
Yeah, no, I think so. I think especially with the shift to, self-driving cars and all that sort of stuff. That's just how it'll end up playing out, right? Is that those vehicles will be owned by some corporation or whatever the case. Who knows how the ownership will work with it? But at the end of the day, if it doesn't make sense, if I'm not actually driving the car, but I need to get from point A to point B, if I push a button and the car shows up and I get in and it takes me where I'm trying to go, do I really need to own it? All those things are debatable, but what you can't dispute is that as a trend, that's where we're headed. And I think that when you take all these things that are occurring, this is kind of what brings you into, syndicating real estate and multifamily investments. And it's the fact that you don't need to, because what I hear a lot of people is they think, I'm going to get into real estate, it means I've got to go buy a rental house and I've got to manage the house. Well, that's the beauty. This is why everyone's going nuts over multifamily syndication. It's not like, multifamily syndication's been around for a really, 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 really long time. It's not like it's a new idea, but to many people, in this country, and it is somewhat of a new concept because they didn't realize that it existed, and they don't But to your point, like if you can invest as an LP in a deal, and you basically know enough to know whether or not you feel comfortable with the sponsor and the asset, and you put your money in, you basically keep tabs on it quarterly, and you accrue the benefits. That's a pretty sweet deal, right? Like that, and not to mention that return, you get.
I encourage the students I talk to be active, passive investors. So, read the reports. Like, again, back to the mutual fund, I can call this, I couldn't even call the manager, the stock, the portfolio manager, but I encourage people to be active. Ask the GP or the sponsor questions about, what the strategy is and why expenses are up or NOI is down or vice versa. You don't have to be a pest, but you can gain a lot of education that is perpetuating downstream for you. The other thing, following up what you just said, Lance, I know you agree. It's the hard asset concept. In today's world, everything is escalating or rising in prices, stock market included, and nobody knows where this is going to go. But when there is a correction, I would prefer to have my assets in a hard asset such as real estate than I would the stocks and bonds. Yes, it'll be correlated. It may be affected, but it's not going to be affected, or it's going to come back quicker than will a mutual fund or a bond fund. Yeah,
there's no question. That you have to have a stomach for volatility, and anytime you're in a public market, it's just you have to get comfortable with the volatility that comes along with it. Because even something that on the surface, you talk stocks and bonds, that's code for equities and debt, right? That in
Right.
theory, it's debt. It shouldn't have volatility. That's what we want to believe but that's not the case. I mean, right now you can't get any yield at the moment out of a bond. Like, it's crazy. It just doesn't. I mean, you have to take on a lot of risk, right? We're talking like junk bonds are doing what,
Especially when you put it up next to inflation.
3.5% or something like that. So they're barely ahead of inflation, and there's a lot of default risk, and you have to be comfortable with the volatility. So it's just, that's the beauty of the real estate, is that you don't have the volatility, right? There's a hard asset. And if, you buy, location, and you've got people who are good stewards, deal sponsors, investment managers who know what they're doing, it's not to say that it'll always be great. We're going to go through rough times, and maybe the income, maybe the checks you were getting, they stop because, we go through a pandemic or something like that. But nonetheless, the asset's still there, and people still need a place to live, and those sorts of things. So I think that it's definitely you hit better at night.
You hit another big one there, right? Another big one. We talked about macro trends across our society, but that everybody needs a place to live. That's human nature. They may not always have to have a car. They may not even have a job, but they do need a place to live.
Yeah, and they need a place to live, and that's what you see is that's what makes multifamily a bit different from some of these others, as we've seen in retail. And it's not that those are bad, but that just, even office, right? Like, everyone's reevaluating, do we really need this office? So, but even then, when you look at when they're going through rough times, it's still not that bad. It's certainly not nearly it's not as volatile as sort of anything in the public markets. So,
well, you got, when I was a kid, I remember Sears and Roebuck was the predominant retailer in America, and we all know how they went in the last 5 years, bankruptcy, and now they're out of business, got pushed out by Amazon. But I don't see anybody pushing out personal property or home ownership or apartments. It's just,
no,
technology's never going to replace it, put it that way.
Yeah, no, that's exactly right. So for you, are there certain markets then, obviously you're bullish on multifamily, but are there certain, markets right now that you have kind of a keen eye on, that you feel good about, or that you're looking at, especially given that, your purview with all these coaching organizations and things like that? What's kind of the hot markets, or the markets that one should be looking at?
So I'm an Ohioan I'm a native Ohioan, came down here and said, so I always say that the answer to your question is anything Texas. And I say that not as a Texan born and raised, but one just as a transplant, because I really, the demographics in Texas just can't be denied. So I'm in Houston based. We like the group I'm partnering with. We like Houston a lot. We're actively seeking apartments to buy, transition in Houston, San Antonio. And then I'm also looking at the tertiary markets outside of some of the four big areas, the Houston, Dallas, Austin, San Antonio. Those are the big four markets. As a private investor, as my own investor, I look at, I've got several, I've invested in Ohio, Oklahoma, actually one in Louisiana. So I've actually invested in Colorado before too. So, there are a lot of great markets. As a private investor, as an LP investor, just get to know the sponsors and get to know what their track record is and what they're looking for and how they underwrite, and know some of the assumptions, and back to that active, passive, and know what you're getting into versus what I would call just throwing your money in a REIT or a mutual fund. That's speculation. But educate yourself and be an intelligent investor. That's what investors do, is they mitigate risk versus speculating on, Texas is hot, so I'll just give Lance $50,000 to go invest in this property.
Yeah, no, exactly. So as an LP investor, what do you recommend that people do in terms of, let's say that you had a net worth of, $5 million or whatever. And so then you had $500,000 that you were kind of like, well, yeah, I want to, this is what I'm going to start. So would you recommend sort of diversifying by sponsor and by market? Like how would you sort of counsel somebody to kind of allocate that capital? Like what are the things they need to be thinking about? Because I mean, I feel like that's where a lot of people get kind of stuck. It's like, okay, great, I got some dry powder here. Like I get it. People need a roof over their head. They're all excited, but then it comes to like, okay,
What do I do?
like what do I do, right? And so of course it's not just as simple as the sponsor and the thing. You've got core, you've got core plus value, light value add, deeper value add. I mean, I'll redevelopment and opportunistic, right? I mean, like
All the way down.
yeah, you can sort of, you can anything in between. So how do you advise people? How do they work through that process or think through that?
So I think first of all, I want to give to your listening audience encouragement to those that don't have a $5 million net worth. You don't have to have that kind of money. I think to be even in to be in a syndication, generally you'll see $50,000 as an entry fee. But the first couple ones I got in, I had the cash, but I didn't want to. I wanted to mitigate the risk by partnering with somebody. So you can form actually an LLC, 2, 3, 5 people, form an LLC that invests in a syndication if you so choose. It's a little more complex. There's more paperwork, but you can do that. Yep. So you don't have to have $50,000. You can form a trust to do the same thing. You can invest through your self-directed IRA. And I think those are venues that common people may not even think of to use. Yep. But to answer your question, if I got $5 million or even if I had $1 million that was disposable or even less than that, I mean, I think it's knowing the sponsorship group. It's the old illustration of the jockey and the horse in a horse race. Which one's more important, the jockey or the horse? Well, the jockey is the GP or the sponsor, and the horse is the submarket that you're investing in. So I will encourage people to get to know the general partners that are coming out with these offerings. So how do you do that? Well, one is join one of the big educational groups to meet them, hang out on your podcast. I'm sure you interview many of them, make an appointment, follow up with them, get on their mailing list, start to have a relationship with them. It takes a little more time, but that's where you're educating yourself as an LP. And then, start analyzing deals. You'll get on the list. Somebody sends you a property in Topeka, Kansas, and you'll get another one in Dallas, Fort Worth. Yep. Well, what's the pros and cons of those? And yep. You've got a network then of asking people and inviting them to help you out.
Yeah, no, I agree. I mean, and that's part of I don't know if you have a chance to check it out yet, but I mean, on Veravest.com, my day job, that's what we put together was, I mean, I heard that a lot from investors was, great, I'm sold. I love the stuff I want, but where do I find these guys? Where do I find the deal sponsors? Where are they at? It'd be nice to have a single place to go, right? And so we built the directory. I think we've got pushing 1,200 deal sponsors up on our directory, and and really, I mean, I agree with you. So, and I didn't pay Randy to say these things, people. So,
no, he did not.
I think that it really is. I mean, I believe the same thing is sort of the jockey and the horse, right? It's the people that are running the deal. It in this game, it makes a huge difference, right? So like the same group could be running the same property, right? If you could run them in a simulator, and one, it could be a complete dumpster fire, and the other one would like 3x your money. Like I mean, probably not that dramatic, but it's just knowing that the people matter, the team matters, what their business plan is, all of those things are very, very, very important. And so first things first is you need to find who they are, which is what we help do. And then the second thing is that high level stuff, which we've also done through feedback, right? It's just, well, are these crooks and criminals? It's nice to know that they're not. That's the sort of thing you don't like to take people's word for. Are you a crook or a criminal? Will you defraud me? No, I won't. Okay.
I promise.
I promise I won't. Okay, great. So running background checks on principals, and then really, backing up or verifying the claims they're making. I mean, if they're telling you they bought $1 billion worth of real estate, then they should be able to back it up. And I think that is one of the problems. Obviously, I'm biased, but in our industry, misrepresentation it runs a little rampant.
Well, also, I mean, it's a big country, but it's also a small space in multifamily. I mean, I'm sure you could make 2 phone calls and find out about Randy across the country, and coming from Portland, and I'm in Houston, and vice versa. Yeah. So it's not that hard, and your service obviously is a huge step for potential investors to consider. Yeah. And all you need is one blemish in this space and you're kind of done.
You are, and that's why it's the other piece, right? Is that I tell everyone, it's like, don't skip the reference call checks, right? Because I think that people feel like, well, if you gave me these list of investors to call, they're just going to only say great things about you. What I found is that when I ask people for lists of investor references and I call them, they don't all have nice things to say, right? So, and I think that's the beauty of it, right? Is that when it comes to investments and you talk to someone else who's invested, it's sort of, it's unlike other services where they might just tell you, oh, it's great, they're wonderful. Yeah, it's like there's no consequence. But if, I don't think any of us want to be in a position where we're going to tell some other person that something's wonderful, especially when it comes to, them deciding to invest or not, right? And I think that's why I've had that experience, is that they're going, this person's calling me, and I certainly don't want to make it sound like it's all wonderful if it's not, because then I'll feel responsible if something bad happens, after the fact. And I don't, none of us want to be in that position. And I also think that it's also why it seems that many investors aren't like, they're not running around and referring, telling all their buddies about all these great investments or people they work with, which is bad for the sponsors because it doesn't spread. Word of mouth isn't as
I can't agree with you more. I mean, my first multifamily limited partnership investment was a train wreck, and I have told this story many times, but it's a great story about, as an LP, it's a business that you're investing in at the end of the day. So the first asset was a friend of mine who I'd met at one of the mentorship groups. He is a successful corporate guy. I tend to gravitate towards sponsors that are corporate guys because I think it's some background education, et cetera, sophistication. Bought this property in Port Arthur, Texas. For your audience, that's about right on the Gulf, about 120 miles due east of Houston. And the property had been abandoned, and the city owned it, and a developer bought it and rehabbed it. And my guy bought it from the rehabber. It was only about 70% occupied, so it was a bridge loan. I didn't know what a bridge loan was at the time. And he leased it up to about 90%, refinanced it, and within like 12 months of us buying it, it threw back 60% of our investment. So I'm kind of puffing my chest and thinking I'm a pretty smart investor here. I know what I'm doing. Well, then right after that comes Hurricane Harvey and wipes out the whole first floor of 225 units and start to rebuild from that. And what happens is a fire and takes out like 20 of the 225 units. And if you do this long enough, there's going to be fires, and whenever there's a fire, the owner's going to get sued. Doesn't matter if you're right or wrong. Regrettably, on this property, there was a couple kids that were died because the mother had left the children in the house, in the apartment, unattended.
Oh my goodness.
Doesn't matter. The owner's wrong.
Yeah.
Start to rebound from that. And then what do we get? A global pandemic.
Yeah.
3 strikes. And so I tell this story, and there's a whole lot more to it, but the bottom line is this guy sold it in last year, the summer of last year. So I'd been in it 6 years, got all my money back. Didn't lose a dime.
Yeah.
I was happy as a pig in mud. Why? Because the sponsorship guy had, in the operating agreement, he had lent a bunch of his personal money to the property, of which he's allowed to do, all through the operating agreement, legal. But he's also able to pay himself first before he pays the investors. And in this particular opportunity, he made the investors whole before he ever took any compensation or repaid his own notes.
Yeah.
So even though I made 0 on this property, I will invest with this guy forever.
Yep.
Just send it to me. I won't even look at it. not quite that bad, but
yeah. No,
so
but I hear you. And that's a great point, right? Is that it does. And this is the stuff that I'm always harping on people. Like, I know you hate to read. I know you don't do these things, but it's like you need to understand that. See, that guy didn't have to do that. Now, of course, he did the right thing, which was made you guys whole. But you guys were subordinated to his position. I mean, in a liquidation, he should have got that money, and you should have went backwards. But and I think that it goes both ways, right? It's to understand that, one, okay, if it's what it says, you need to assume that that's what they'll do. They'll do what the agreement says. Don't say, and especially because what a lot of guys do say, well, that's what it says, but that's not what I'll do. Okay, I'll take your word for it, right? And of course that'll be the time when they take their money and you don't get it back. So it's those are the things where you got to read the agreement, understand what it says, assume that's how it will play out, that no one's going to do you any favors, and
read the agreements. I couldn't agree with you more. And few people do. Read the operating agreement. Read the PPMs. Because you've seen one. They're all different.
You've seen one. Yeah, and it is at first it's slow going, but the beauty of it is that once, after you get used to doing it, right? Like you know what you're looking for, and you can see. I mean, I'm a compare and contrast guy. Like I like to have things to sort of, to compare against, right? Like only seeing it one way, it's hard to sort of figure out what it is. But you see a bunch of different varieties. It allows you the pattern recognition. You can pick it up. But it's important to read those things, and over time you get used to it, and you'll catch little things that I think, especially in the waterfall stuff, where the lawyers, it's not like they're intentionally trying to do that, but sometimes it just gets really heavy. But you read through there and you got to think about that, like what is this saying? And some people have got some sneaky waterfalls where it's like, like the cash flow that I don't know. It's just some things. There's some stuff that I've seen that I'm like, oh my God, I can't believe that people put money into this thing, because that's just like.
Well, and that's all part of the educational process, the LPs. I mean, a simple capital stack versus a complex capital stack. I mean, if it's got a waterfall in it, I'd encourage, unless you really know the GP really well, find a simple capital stack to start with. It's just easier to comprehend and to grow from. I still like those today versus the complex ones that with front end fees, mid fees, refinance fees, disposition fees, et cetera, et cetera.
Yeah,
waterfalls, and it's just it's more complex for the person starting out unless they've got more experience.
Yeah, that's exactly right. Cool. So what would be your what's the parting wisdom? If there's one piece of advice you can give somebody that's, like you could give yourself back when you first got into it, what was other than, educating yourself, kind of what's the one?
Well, I would say, Lance, it is education, but in that too, if I had a 1.1 or a 2 out of that, I would say it's networking. So it's build your network, build your team. So it's education, know what you want, whether you're an LP or a GP. Build your team or your network of people you're going to touch base with. I mean, there are people I today run by deals with. Hey, have you seen this one? What do you think? That's a huge benefit to me as an LP. Reach out to. I'm sure you'd make yourself available. I'd make myself available to talk through one with somebody just to get them on their feet and get them going. But I would summarize education, networking, and building your team.
Yeah, I agree, and I'll echo that too. I mean, I think that the networking one, it's good we sort of called it out as a separate thing, because the other thing that I see a lot of, the truly passive investors is that they sort of treat it like this armchair investing deal, right? Where they'll call me and they'll be like, I'm looking at so and so, and I'm they start trying to poke around it, and they got a lot of information. I'm like, well, I mean, you could just ask them. So, like, no, I haven't talked to him yet. I'm like, you haven't talked to him? How did you get all this information, right? Like, I'm like, you need to let them know that you exist, because for whatever reason they love this anonymity, right? Like they want to hang out and lurk as long as they can. I'm like, you're doing it wrong. Like you really need to reach out. You need to build relationships. It needs to go both ways. It's a relationship thing, right? And so that is a mistake that some of them, they take it like it's this super analytical, it's just, I don't know, like it's a job interview or something. I'm like, And
I'm guilty of that as a finance guy, of overanalyzing things. Engineers are the same mindset. A lot of technological people are very analytical in nature, and there's nothing wrong with that. But at some point, it's got to become relational, and you got to pull the trigger versus analyzing it to death.
Yeah, most definitely. Cool. Well, where can people learn more about InvestArk, and where can they connect with you, Randy?
Well, Lance, thanks again for the opportunity to be here. The easiest way to connect with me is my webpage, which is invest, ARK, A-R-K, invest-ark.com. There's a contact page on there. Lance, I'd love to spend 15 minutes or half hour with anybody that wants to talk real estate, just to help their journey along the way. So many people have built into me, and I just want to help give back. So
Cool.
Enjoyed it.
Yeah, I appreciate that, Randy. Thanks so much. Take care.
All righty.